Hi there, it's Bill with Smart Trades, and it's November 17th around 11:05 a.m. Pacific Time. I'm going to do a quick review of the S&P. Also, we'll look at the Euro FX and take a quick look at gold and crude oil. Um, First, off the top, here's our preferred count on the S&P, sort of a tentative preferred count in that I have some problems with it. I do have some questions about how this whole pattern is unfolding. Nonetheless, this is my working count at the moment, and so I'll stand by it for now. Let's look at the previous fourth wave of one lesser degree, which I had mentioned in my report on Monday as being support. That comes in around 1177, actually just a little higher than that. We did get down to about 1173, but on a closing basis, an hourly closing basis, the 1177 area did hold, and obviously we're above there right now. And these charts are a bit dated, as is often the case, because I work on them a bit before I actually record the video. At any rate, on this count, we have a series of 1-2s off the high. I think that's a little bit difficult, a little bit of a stretch that we're in that many 1-2s off the high. It would indicate we'd have a whole series of 3-4s and then perhaps a decent correction before a much larger decline. But indeed, it's certainly possible to count it this way. You can see we've got lower peaks on each of these rallies, and there's a fairly nice trend channel. Based on this count, the target should be around 1186 for a small fourth wave. We should go pretty much sideways to slightly higher over the next day or so. Here's an alternate variation. One of the problems that I had with the previous count was that we had a very short fifth wave relative to wave 1 in this 5-wave pattern, i.e. 1, 2, 3, 4, 5. If you use this count, we have a somewhat deeper fourth wave. I don't have it labeled here, and then a more symmetrical fifth wave that fails just shy of the 1219 level. And that 1219 level is key. You don't want to see that area taken out. It's if you're a bear here. If we do, I think that 1230, perhaps even higher prices are likely, but we'll cross that bridge when we get to it. And again, assuming this count, it really doesn't change a whole lot in terms of the short term. You just eliminate one of the 1-2s, so to speak, and basically it'll shorten up this decline, at least the initial phases of it. And again, we have 1, 2, 1, 2, 3. We're working on a small fourth wave. This would give us another decline to a new low, a rally back up perhaps again to around 1186, and one more new low before a larger corrective rally. Now, here is that same count, but what I've done is I've highlighted the previous small wave 1 here, 0.1, and that low is 1194.08. On a closing basis, 1195. Basically, one of the key Elliott wave rules is that you don't want a fourth wave to overlap into the territory of the wave 2. You don't want it to overlap the apex of wave 1, as it were. In this case, on a closing basis, we do not want to see the S&P have an hourly close above 1195. If it does, it pretty much breaks this count, at least the way it stands here. It's not to say that we couldn't go down in some other pattern, but it breaks this series of 1-2s, and it breaks this very bearish pattern. And on that note, let's look at an alternate count. This decline from that 1218 and change area, just shy of 1219, can be counted as an expanding triangle. And in this position, it's not implausible to think that it might be a C wave. In this case, you have an A down, a B back up, 5 waves, an expanding triangle of C, and that bottom's very close to that previous fourth wave support. Again, just above 1177. 1177.65 to be exact was our previous fourth wave apex, and indeed we are just a fraction of a point on a closing basis from bottoming right at that previous fourth wave apex target. On to the euro. The euro FX, as you've probably seen in my previous videos, I have this labeled as a wave 3 up, a contracting triangle wave 4, a fifth wave, and then an impulse down. I think we're probably getting close to the end of this leg down. If indeed it is a wave 1 down, we should see a corrective rally. I'd prefer to not see that rally go above about the 140 level. Perhaps the 137.50, 138 area might be an initial target. These are very tentative projections here. Again, we're not even sure that this leg has bottomed, much less where it's going to peak if indeed it's we're going to correct it. But it just gives you some idea of the form that the next rally might take. Now here's an alternate. Again, I had counted this sideways pattern as a triangle, but it occurs to me looking at it that this could be counted as an expanding flat correction, A down, B back up to a new high. You'll notice that we reverse that rally to a new high very quickly, and then 1.62 times A comes in very close on a closing basis to the bottom of this leg down. Additionally, if you'll remember, I did put these regression channels around this longer term rally, and we are approaching the bottom of that regression channel, which oftentimes is a place where a market can get a bounce. Now, the nature of this bounce is really going to tell the tale, but certainly this is a possible scenario, and on a longer term basis this trend is still up. Also of note, this expanding flat pattern, if you'll notice, is very similar to what we have in the stock market. Now, please don't hold me to the scale of this ABC. I'm just trying to show the similarity in pattern here. We've got an A down in a three-wave pattern, a rally back up in a three-wave pattern, a decline to a higher low, and then a rally to a new high. And again, that same pattern is exactly what we have in a weekly or daily chart of the Dow, S&P, NASDAQ. The Dow probably is most similar symmetrically to that Euro chart. And again, our projection here is for the C wave down below the 9,000 area if we have a 1.62 times A ratio for our C wave. And finally, on the Euro, here is that longer term picture, and again, here are the regression channels that we are approaching. I've simply connected the high here at wave 1 to the low at wave 2. This isn't standard Elliott. I'm just trying to show the distance between either end of the span within this channel. And I've cloned that, and you'll see that we are very close to identical depth and time duration in terms of wave 4 relative to wave 2. Now, what's also nice is we have alternation in terms of form, but the basic pattern in terms, again, of time and the depth of the correction are virtually identical. So it is worth watching this area here for the possibility that this is actually a correction and in an impulse pattern. As long as we don't overlap 133.28, the high of wave 1, it's possible that this is actually a fourth wave, and we've got a fifth wave to come to higher prices. There are other scenarios where we could overlap that. We could still go higher. This could be some form of zigzag or whatever. But the bottom line is, ideally, assuming that this is an impulse, we should not overlap wave 1. And we should hold very close to where the recent lows are, perhaps dipping down one more time to test that channel and have an exact hit on that relationship to wave 2. Here's a quick look at crude oil as promised. Crude, pretty much following the script to the T, hit the top of that channel went through for a couple of days and then fell like a stone, and it's still falling as I write here, or as I speak, I should say. And last but not least, Google. Now, if you're looking for a perfect example of what an Elliott wave, impulse wave looks like, here it is. Google is declining in 5 waves. You can see wave 1, wave 2, and then within wave 3, we have a textbook 5-wave pattern as well. We've got a peak volume and momentum at towards the end of wave 3, wave 4 rally, and then a 5th wave of similar magnitude to wave 1 down. Could it be a component of some larger corrective decline? It's certainly possible. Nonetheless, I think Google has been a leader here. I would watch Google very carefully. This rally back up, the previous 4th wave resistance around that 600 to 605 area will be the first area to watch carefully. It could go back up to this previous shelf. That's around the 615 area. But the key is that this rally in Google, A, should not make a new high. It should not go back above 630 or so. And B, the nature of the next rally should be corrective. Even if the S&P and the Dow make new highs, if this rally in Google is corrective, I think that's a huge red flag and probably indicates that we're going down at least for another long, sharp leg to the downside in the broader market, as again, I think Google is the leader. Hopefully you're having a great day and a great week ahead. Thanks so much for watching. Have a good one. Bye-bye.